Cast, we're going to look at part 3 of the Bob's Instant Coffee Cart case. We'll look at issues related to acquiring assets, to the valuation of those assets using the principle of fair value. We'll also take a quick look at present value and some of the details for issuing common stock. As always, we present the narrative, and note that in the third part of the case, we have expanded the number of transactions, so this should require a little bit more work on your part. To get started, here's the balance sheet at the beginning of May, which is where we left things from part 2. The first transaction we're going to look at is where Bob decides to purchase the instant coffee cart. The coffee cart has a market price of $22,000 and an estimated useful life of 72 months. In order to purchase the cart, BICC tenders $6,277 in cash and signs a note in which it agrees to pay $500 a month for each of the next 36 months. To record the transaction, there's a debit to the plant and equipment account for $22,000, a credit to cash for $62.77, and a credit to notes payable, a liability that will have both a current and a non-current portion, though for the sake of this example, we will ignore the distinction between the current and non-current portion. Of particular interest to us is where did the $15,723 valuation come from? So first, before we get into the valuation issue, let's take a very quick look at the balance sheet and notice that the journal entry should impact the balance sheet, and I have highlighted the 3 accounts that will be affected. After the purchase, notice the balance sheet after, and you should be comfortable with why the balance sheet changed from the before balance sheet to the after balance sheet. Now we want to take a look at the note payable. When a company acquires an asset, it's usually assumed that the asset is acquired at its fair value and that the asset received is equal to the assets or promises made by the company. We know the fair market value of the asset at the date of acquisition is $22,000. So what the company gives up should also be equal to $22,000. Well, cash is easy to value, unless of course it's in a foreign currency, but that's not the case here. And since the amount of cash given up is $6,277, but the other thing given up was a note payable, and the note payable really is an IOU, a promise to make future payments. So how do we know that the note payable is equal to the amount needed to balance the transaction? In order to determine this, it turns out that the key element here is the discount rate. Now, the discount rate can either be the cost of capital for a company, or it could be the interest rate implicit in the valuation. And that's what we're going to use this time. In other words, by assumption, we will assume that the transaction occurred at fair value, which means that the interest rate is what's needed for the transaction to equal out. Since we're looking at the note payable, this gives us an opportunity to review present value concepts, and probably one way of seeing how to value the note is to create a table of present values. So the table would consist of time, the amount of the cash flow at each time period, the discount, where the discount is the payment reduced by a present value factor, and the present value factor is based on the discount per period, which in this case is 0.75% per month, and the number of time periods. And then finally, in the fourth column, you can see the present value. So what this slide says then is that in time period 3, a cash flow of $500 discounted at 0.75% for 3 periods is equal to a present value of $488.92 at time period 0. Now the note consists of 36 such payments, and if we were to create a table with all of the payments for the entire 36-month period, and then if we were to sum the present value of each of those payments, we get to $15,723, the amount that we actually need. And the important thing here is that the interest rate, 0.75% per month, is exactly the interest rate required to get to this present value of $15,723. Remember, this is the amount required to make the transaction a fair transaction, in the sense that what was received is equal to what's given up. So in this case, that 0.75% per month is exactly the right discount rate. If we chose a higher discount rate, the present value would be less than $15,723. And if we picked a lower discount rate, the present value would be too high. The next transaction we look at is the issuance of additional capital for cash. So this is a fairly common situation for businesses. At some point they need additional working capital, and there really are two sources for working capital. Either you borrow the money and take on debt, or you get additional equity investment. And what we're showing here is what happens when you get additional equity investment. Company gets additional cash of $10,000 and recognizes additional contributed capital of $10,000. And once again, we can look at the before balance sheet and the after balance sheet. The next transaction is the payment of an account payable from the prior month. So here's the account payable, and this was incurred in April, but it was required to be paid in May. And so you can see the debit to the account payable, which will reduce the account payable balance to 0, and the credit to cash, which should reduce the amount of cash on hand. I won't show the after, since it's a relatively simple transaction, and you should be able to do that one yourself. The transaction is fairly straightforward. Inventory of $3,600 is acquired, $3,100 is paid currently, and a promise to pay $500 in a month time is also made. As is usual, we leave you with a number of variations that you may want to try to test your knowledge and understanding of the accounting concepts covered in this video.